I'm Dustin Hutley, and I'm a loan officer and branch manager here. I've been in this industry for 10 plus years. I love helping people buy houses. Me and my team operate from the value standpoint that purchasing real estate is one of the best long-term decisions that you can make when it comes to building generational wealth. I have a bunch of videos that is going to help you understand what does that process look like in getting qualified up front and closing on a house in the future. I'm going to talk through the initial steps. What does it take to get qualified to purchase a home? Set the right expectation, what you're in for when it comes to getting qualified before you make an offer on a house. You and I are going to have a quick discussion just to talk through your situation. It allows us to understand your financial picture. We call this a discovery call. I'm going to ask you questions about your income, about your credit, if you have any money saved in the bank. It should just be a very quick conversation. So I'm going to send you an email with a link for the loan application. And a loan application is really that first step to get started. Then in our online platform, you'll be able to look at what documents are needed. We'll start off with an initial set of documents like W-2s, pay stubs, if you're self-employed, tax returns. All those items will be in that platform so that you can see what's needed and you can upload securely into there. Once that's done, my team starts to review your situation. Usually takes 24 to 48 hours, assuming that we got everything that we needed. And then we'll follow up with you with what we call an approval consultation. And this will discuss, are you approved right now? Or what's the plan to get you approved? Not everyone's approved out of the gate. And we'll talk you through what that strategy looks like, depending on if your credit's low or if your income's not high enough. We'll give you plans that you know how to get prepared for the future. But if you are approved, then we'll do an approval consultation to talk it through with you, what your monthly payment looks like, interest rate, loan program. We'll look at all the options and make sure that you know exactly what you're getting into so that you're prepared to go look for a house. So once that's done, you can go to your realtor and then you can start looking for houses. If you find a property that you want to make an offer on, just let us know, either you or the realtor, what is the property address. My team will just make sure that we get the property taxes correct, updated insurance, and fine tune those monthly payment numbers so that you know exactly what you're getting into before you make an offer. I see a lot of people that look at houses and will make offers in the price point that they want to be in, but maybe that specific property has some nuances or some changes in the numbers that could make a big difference. So I just say, hey, always send me the address. Let me run fresh numbers on that property. That way you can offer confidently. Now, what does the process look like once I'm under contract? What are your options when it comes to your interest rate and when it comes to your closing costs? When I buy a house, what does that look like? What are my options and how does it work? And how can I use it to my advantage? Let me explain interest rates with you. As a lender or as a loan officer, we have this stack of interest rates and it shows us a whole list of rates. It might go from as low as 4% and all the way up to 8%. So an eighth of a percent is the difference between 5% and 5.125. Well, there is a dollar amount associated with every interest rate. A lot of people have heard the word buying points. It's just a term that's used to buy the percentage down in interest rate. It's just a dollar amount associated with each interest rate. There's an interest rate that essentially costs you $0. We call that the par rate. If this is your teeter-totter, you have the interest rate over here and you have the price of the interest rate over here. As the interest rate goes higher, inversely, as the interest rate goes lower, the cost for that rate goes up. They may want to take a higher interest rate than the par rate because it comes what's called a lender credit. What's a lender credit used for? A lender credit is used to actually lower your closing costs, where you take a little bit of a higher interest rate, which has a little bit of a higher monthly mortgage payment, but you're keeping a little bit more extra money in your pocket. If you decide to buy the rate down, what that means is you're buying points or buying a percentage down, that dollar amount goes up. So you have that par interest rate, right? That costs you $0, but to buy the rate down, the price goes up. What's the difference in my payment? The par rate, let's just say my monthly payment is going to be $3,500. If my payment at the par rate is $3,500, but I could spend $1,500 to buy the rate down an eighth of a rate, the difference in payment on that is $30 a month. Well, that's awesome. How long is it going to take for me to make up the $1,500 that I spent on that rate? So we just do a calculation. So $30 of savings every month times 12 months is going to be $360 for the year. Well, how many years is it going to take me to make back that $1,500 of spend that I'm using today to buy that rate down? And that might be 4 years, it might be 5 years, it might be 7 years, depending on the situation. You need to look at what's my ROI on the investment to buy the interest rate down. And it just completely depends on the interest rate market that we're in. What I would say is right now, this is a rate market where I don't always advise people buy the interest rate down because there is a chance in this particular climate that interest rates in general may fall in the near future. Now you're in a position to actually refinance. Well, what will happen is that you'll just have left money on the table. you'll be out that money. You won't have gotten your return on investment, either buying it down or taking a higher interest rate and getting a credit, and what that looks like. Now, here's the cool thing. You might be able to negotiate what are called seller concessions. Another word is called a seller credit. This is something that's done upfront or at different stages in the process where there's room or opportunity for further negotiation, which would be at inspection or at appraisal. So for example, let's just say you can't afford to cover your $10,000 of closing costs. The best way to do that is to ask the seller to provide a seller concession of $10,000, which will cover your total closing costs so you don't have to fork that out. And that's something that you'll work with your realtor and you'll work with your lender on making sure that that can take place. You can use the seller's money to benefit yourself. You can get enough seller concessions to not only cover the $10,000 of closing costs, but maybe there's additional amount that can be used to also buy your interest rate down. But there are other costs associated with the transaction when you're buying a home. So you have number one, your down payment. Number two is something called closing costs, and we'll break that down for you. The other thing is called a home inspection. Fourth thing is an appraisal. One thing that a lot of people don't always understand is something called earnest money. Earnest money is 1% of the sales price. So let's just say it's a $500,000 home. 1% is $5,000. So what is earnest money? Well, earnest money is really just a dollar amount saying, hey, I'm serious about this house. And so once it comes under contract and you agree upon that, you're gonna first write a check. It's going to be that $5,000. It's going to go to the title company, and the title company is going to hold that money throughout the remainder of the transaction. Let's just say your total down payment is 5% down. Your down payment when it gets to the closing table is going to be 5% down minus the earnest money that you already put forward up front. The next fee is going to be an appraisal. Appraisal is usually plus or minus $700 to $800 depending on the loan program. They want to make sure that the home is worth what you're paying for, and they want to make sure it's worth what they're lending on. This is also a cost that is going to be just paid for with a debit card or credit card. You're going to pay for it out of pocket in the transaction. This fee will not be included at closing most of the time when it comes to buying a house. Now let's talk about your down payment and then something called closing costs. So your down payment is of course a percentage of the purchase price, which is already agreed upon in the very beginning. You know what that is before you ever make an offer on a house. Now we have what's called your closing costs. Now your closing costs is all the costs that it takes to close the transaction. There's a title company involved. There's the lender that's involved. They have their own fees. If you're gonna what's called buy the interest rate down, you can pay money to get your interest rate lower, which is overall gonna lower your monthly mortgage payment. The big one is what's called escrow. Escrow is property taxes and your homeowner's insurance. These are two things that are required on every purchase, and your escrow is going to be a lump sum of money that's included in your total closing costs, where they're gonna pre-collect a certain amount of months of property taxes and a certain amount of months of homeowner's insurance. This all gets included. You've made an offer on the house, it's been accepted, you're under contract. This is where me and my team really start running with your file. We need to refresh your file a little bit with some updated pay stubs, maybe some updated W-2s or bank statements or whatever is needed to make sure that your file is fully up to date. And then what we do is we reach out to you, we get those documents, and then our team will then submit your file to the underwriter. And underwriting, they're gonna do their full audit on your file and just make sure that everything's dialed in to get your loan to closing. The next thing that we have is what's called initial underwriting approval. So once an underwriter does their review, they will follow up with any additional items that they believe are needed. And then we have what's called a processor who's on the team who's gonna follow up with you and be that liaison to help collect the documents that are needed, and then they'll submit that back to underwriting. The inspection is to help figure out what's wrong with this property. The home inspector shows up, they do their inspection, you get the report. You could potentially negotiate of what's called a seller concession. It can be used to cover your closing costs, or it can additionally be used to buy down your interest rate. The next stage is what's called an appraisal. So assuming we get past inspection, we will then order an appraisal. So what will happen is you will first pay for the appraisal up front. You'll get an email invoice where you're gonna pay for that appraisal, and then it's gonna get assigned to an appraiser. An appraiser is gonna show up to the property, they're gonna do their own inspection of the property, and then usually a few days later or maybe a week later, they're gonna provide an appraisal report. Let's just say the agreed upon purchase price is $500,000, but the appraisal comes back at $490,000. So ultimately what it means is when the appraisal value, if it comes under the agreed upon purchase price, it's another point of renegotiation and figuring out if this transaction is gonna move forward or not. Now, what happens when it comes in at value? If it comes in at value, things move forward like normal. What happens if it comes in above value? Well, we call that instant equity. So once we're past appraisal and now there's no further negotiation, now we're very close to closing. Our goal is to get this what's called clear to close. close. And that really is issued by the underwriter. Another term for it is we call it final approval. So final approval or clear to close are interchangeable. So now what happens once we get the clear to close is the closing team for the lender is going to work on what's called the final doc package. This is the large set of documents that you are going to sign to close on this house. Then the lender is going to what's called send their wire for your loan. And they're going to send that wire to the title company. Your loan is officially funded, but it's not closed yet. The next thing that happens is that it has to record with the county. And once they record with the county, you get your keys. And your realtor will coordinate with you when it comes to when you can get your keys, when you can have access to the house. Well, it has been a pleasure to walk this through with you. I hope this is valuable. We are in the business of helping you be educated and making sure that you know what you're getting into, making smart decisions, and have all the information that you need to make great home purchases. I'm Dustin Hutley. I can't wait to work with you. My team can't wait to work with you. Have an amazing day, and we will be in touch.